mortgage agent with Pinapple Financial, which is right now we have about 600 or 700 agents right now, and we rebranded. So if you haven't heard about it, it's just because we rebranded it about a year and a half ago from Capital Lending Center. I myself, I have been in this industry for just barely about 3 years, but I've been working for a bank before this for about 20 years. And I specialize in personal finances, especially mortgages. I have worked anywhere from offering clients mortgages to actually leading a team of sales officers for mortgages. And my last job at the bank is actually I work at the head office and creating mortgage policies, and also like the pricing tool for across Canada. So today's agenda is going to be pretty full, and I hope I can make it through in about 20 minutes. Technically, I will have some of the information that if most of you are first-time home buyers, it will be very appropriate that you will get a lot of information. You might, if you don't have a pen and paper ready, you can always call me back or call Simon and the team back to ask for information that we can talk about. So first question, first-time home buyers. I think Sunil just saying is should I buy or should I rent right now? It's been one of the biggest questions out there in the market. So let's take a look at some of the things that is buy versus rent. So if you are buying, the good thing is you're building equity. Real estate technically is a really good investment and is a very good part of your investment portfolio, because you also have a lot of stability. And even though there's a lot more privacy, because now you're staying in your own home, you can do everything. Nobody's coming and bug you because it's your own space. So it's especially during COVID, it is really your sanctuary. So for that, those are really good things to buy. But to a lot of people, that is a commitment. And there's ongoing maintenance costs. Say, I just have a little leak in my garage over the weekend because of the snow. So now I have to get people to fix it. If I rent it, then it's a landlord's issue, right? But this is my house. I want to fix it. And this is what I have to deal with. And then in today's world, the mortgage payments might be higher than rent. But as Simon just mentioned, right now, 1 bedroom is $2,500. 2 bedrooms, I think they're going over $3,000, which I'm going to show you some of the payments that you can see to see how it actually compares to it. So, so the good thing about the renting, if you're not ready, is it may be cheaper, but you have ability. You can move. I like to stay in Durham region. I want to stay in Toronto region. Say there's a little bit of flexibility in that. As I said, there's little or no maintenance when you're renting, and some younger generations calls it financial freedom because they're not now tied down to a house to make these regular mortgage payments. So, but the bad thing is for renting is you're paying someone's mortgage. The money that I collected for my rent, then it goes to the mortgage. So that person, your landlord, is actually going to accumulate that equity that they have. And also the landlord is your boss, which means that it's when they need something, they come to you and they say, oh, I need to take pictures. No, you have to let them take pictures. Oh, I'm going to have a new tenant. So there's a lot of things that is not under your control that causes the instability of renting. So those are some of the basic buy versus rent that you can see, but not everybody is ready. So you have to ask yourself, are you ready? And then just to go back to one page. So, but today, as you know, buying, if most of you are first-time home buyers, there are definitely incentive that you as a first-time home buyer. So if you are going to buying into say in the city of Toronto, which goes back to which accounts for more than half the sales there, in the city of Toronto, they're giving you a land transfer tax rebate of $4,475, and across Ontario you will get per household a $4,000 land transfer tax rebate as a first-time home buyer. On top of that, you might be even eligible for a first-time home buyer's buyer's tax credit for the year that you bought the purchase in, that can be now up to about $1,500 as they just passed the rules. They raise it from $750 to up to $1,500. So there's definitely some incentive to become a homeowner. So now I guess this is like, I hope this will answer some of your questions, Anila, is like, say, should we hold right now for lower rates? Right now, rates now are higher, but then the property price are lower. So in the next, on my next slide, I'm going to show you some of the differences on actually how it influences you or how it affects you to become a purchaser today. And then Simon also said, I mean, once the rates drop, then the people is going to rush to it, and then there will be starting bidding war, and the price will be pushed up again. The other thing that you have to remember is like, there are right now, Canada is open to 1.2 to 1.5 million of immigrants in the next 3 years. And statistically, these immigrants that comes in, there will be 60% that will end up in Ontario, and 80% of those who stay in Ontario would be buying a house within 3 years. In other words, if you are waiting and waiting, you will be in competition with another 64,000 households a year to try to buy a home. So can you imagine, these people come aboard, they're ready, they have the down payment, they're ready, they want to buy a house. Your competition is now increased significantly. And also with the rate lower, it will be like it might go back to 20 offers, 30 offers like a couple years ago. So this is where we have to be careful. So it might be actually a best time to buy if you can qualify even at today's rates. But let me ask you, I mean, if people is like my age or have been in the business for over certain years, 5% and 6% is actually a fair mortgage rate overall statistically. And this is where we're sitting on. But then what I would ask you is like, instead of focus on the rates today, let's focus on the payments, because the payments has to make you comfortable. This is where, like, should I pay $2,500 in rent, or should I pay $3,000 in a mortgage, which I own my own property? So those are some things to think about. So I did some math for you guys. I know it's after some of us have dinner, so it may not be the best time to do some math, but I have done it for you guys ahead of time. So I'm looking at a general purchase price in the 2022 at a house price of about $850,000. At that time, the qualifying rate is 5.25. So therefore, the mortgage amount is about $680,000, and you require a whole down payment of $170,000. For that, your household income requirement will be $132,000 when the rates were lower. So the second line there, I'm using everything the same here so we can compare it directly. So with the same $132,000 household income, now, even though the qualifying rates, please note this is the qualifying rate, this is not your mortgage rate. The qualifying rate is at 7.09, which is almost 2% higher. You can actually afford a home, which is $705,000 with 20% down. But look at your down payment. Your down payment now has gone down almost $30,000 for purchasing. So for the same household income, and 705 versus 850, it's about 12% difference. That means if the price have reduced by about 12%, then you can actually still be qualified with the same property. And if going back to where it's a 20% reduction in the house price from 850, then your house price is now $680,000 with a qualifying rate of 7.09. Then you only need less than $128,000 household income to qualify. Mind you, because I use the same property tax for all of these properties, that means that in reality, if your home is $680,000, your property tax would not be $5,000. So in the bottom right, I actually use like what my assumptions are. They maintain the same for better comparison, but I'm pretty sure like if you're 120-ish, then you can actually qualify for a purchase of 680,000. But again, your down payment now is also less required. Does it make sense to most people so far with this chart? Okay, so in summary, what I'm trying to say is here, the question is, now the rates is higher and I cannot afford it. But the thing is, because even though the qualifying rate is higher, but because the purchase price now, the price of the property has kind of reduced a little bit. So actually is the better offset. With the same income, you might still be able to qualify. So don't get deterred and say, well, it's a higher interest rate. I cannot qualify before. I may not be able to qualify now. So let's talk about something exciting, mortgage rates, which I think is a very, very hot topic. And I don't know, I'm not sure if anybody heard of the word disinflation. This actually is a word right now. It's called disinflation. And this quote actually comes from Federal Reserve Chair Jerome Powell. He say, we can now say for the first time that the disinflationary process has started. We can see it. So with all these prime rate increase, Bank of Canada rates increase, what happened is now we can see is like inflation is actually under control. That's how they come up with the word disinflation. It's not a deflation, it's a disinflation. So I'm not sure how many economists we have on this in this group of people here. I unfortunately don't have a crystal ball to forecast any rates, but if you can see from this particular graph here, the orange line is the 5-year bond yields, and the green line is actually the discounted rate or the average rate for fixed and variable rate. So you can see from since July till 2022, those two lines are pretty much overlapping each other. Meaning, if you know, the bond yield actually has a strong record of predicting mortgage rates. And it's with this, you see the last little part here, it starts to open up a little bit. There's about a 1.5% difference between the bond yield right now and our current mortgage rates. To a lot of like economists, that is actually is a signal that the mortgage are possibly going to fall. But at the same time, we also have to look at our very dear neighbor, the US, because they did say they are going to continue to hike, and that will also affect our bond yields in the next little while. I can only tell you from statistic and historically what is there. But if I go a little bit deeper, it's like, say, that's US, right? But US does have an effect on us, but it's not direct. It's like an indirect hit on us. So we just like have to kind of do our due diligence in Canada to see that. But if I'm going to ask you to take a look in the very first part of the graph there, starting from July, starting from 2017, actually there, our prime rate has not gone up since 2015 until the first climb was actually in July 2017. And then what you can see is also every time they increase only by 0.25%, because that's how they regulate the system. And that 0.25% was increasing until October 20 in 2018. So you can see that orange line was like climbing a little bit, and the green line was climbing a little bit between 2017 to 2018. And then the rate actually has remained unchanged until COVID hits in March 2020. Since then, in March, the Bank of Canada actually have decreased the rate 3 times in that 1 month to an all-time low of an overnight rate of 0.25%. So you see there's a big dip actually in 2020, and that's what happened. And then so now the Bank of Canada have decided to start to bring the rates up to control inflation. That's why we call it the disinflation. The first increase was March 2022, which is actually 2 years after they decided to bring the rates to the all-time low. And then they have continued to increase the rate for the past 8 announcements. And hence we're now, the overnight rate is at 4.25 right now. So, so we can see if I actually take away the dip, if you see here, if I actually take away the dip in here, actually the line is not climbing too fast. It's just because we have that COVID dip. That's why everybody is scared right now. That's really what the market is. In our business, we said the sky is not falling. If we don't have COVID, we probably is at the same rate right now. It's just not drastic move. So tomorrow it will be another announcement. So it was very unsure if they're going to hold or they're going to put a quarter in it. So, but then after March 8th, the following one will be April 12th. So we're going to have to see what the government decided to actually, with all of these budgets that's just announced. And with now we have our inflation is slightly under control with the employment rate, all of those things, it will have all of the effects. So we'll wait for tomorrow at tomorrow morning when they actually announce if they're going to hold or if they're actually going to increase the rate. So as I said, what's happening really with all of these rate changes, what's happened? So what I have captured is like, say, there's mostly three types of mortgages rates that we deal with. One is the insured, is when people have less than 20% down payment. One is called insurable, is when they have when the purchase price is less than $1 million and they have 20% of down payment. And one is the uninsured, which is when the property is over $1 million. So what I've captured here is like, if you go to a restaurant and have seafood, they call it seasonal price or market price. That's what I'm calling like the mortgage rates right now, because you can see they actually fluctuates. There is no one-way street. So you can see for insured, it dropped on February 10th, but it goes back up a week later and it's now has gone up again. For insurable, it went up and then it went down and then it went up again. And then even for insured, same thing. It went up and down, it went down, it went up and it went down. So the reason why I want to show you this, what the rates are going is like, do we really want to wait for the rate? Because is rate an impact on you to actually to decide if you want to buy your house now? Because the rate is fluctuating so much that I cannot even tell you tomorrow what is the rate is. We normally in a couple of years ago, we normally will be able to get like rate changes, maybe like 3 days before they tell us like, we're changing our rates like in 3 days. So get all your application in. Now we get it sometimes, if not the night of, it will be even like we're changing 12 o'clock at noon. So this is how quick and how fast the lenders now are reacting to the rate changes in this market. So come back to the story is like, should I wait? Because like, yeah, like if there is a gap in the bond and the market rate, it looks like that market, the mortgage rate might be lowering. Should I wait? Now, I don't know if you guys have a crystal ball. I don't, but I can tell you it's very unpredictable right now with the rates, but it seems like it's sitting around the 5% area, depends on the type of transactions you have. So for me, it's not really worth waiting if you're really ready to own, especially owning your first home and become paying your own mortgage. So there's a lot about the market stuff just now. So I'm going to go back to some of the questions that people have is like, should I pick a fixed rate or variable rate? Because that's also one of the questions that I heard a lot on the street right now. So obviously with fixed rate, it comes with fixed payment. It's easier to budget because your payment is fixed. And then it's the same rate for the whole duration of the term. So in Canada, you will have a term duration of anywhere as short as 6 months all the way up to 10 years. And the not so great thing for a fixed rate is like if you decided to break the term that you're in, you might be facing high interest penalties. However, I heard about the variable rates. So variable rates that actually your payments can be fluctuating and the interest always changes with prime. So if tomorrow, if like nothing happens to the prime, then your payment doesn't change. But if prime's going to go up by 0.25%, then everybody's people in the variable rate, they will be going into increase by 0.25%. And historically, if you see, I'll show you a graph that they are kind of a little bit lower than fixed rate in the past 10 years. So people sometimes prefer variable rates. And the good thing about them is like, if you decided to break the term, their interest penalties are lower. So as much as I say, historically, they have lower rates. In Canada, as of January 20 and 23, there is the percentage of variable rate mortgages versus fixed rate mortgage is variable rate holds about 32% of all of the mortgages. That means only 1 in 3 people actually have variable rates. So that sometimes is like, it's where like when the media goes out, is like say, oh, my interest rate went up. It's like, you know, my interest rate went up and I cannot affordable. It's no longer affordable. And now I might have to get out of my house. The thing is, 1 in 3 person will have the variable rate. However, there are a couple of lenders, their variable rate are called adjustable rates. What they do is they're not true variable. The payments are fixed. So what happened is then that their portion, every time they make the payments, the portion of the interest will increase as prime increase, and which we then head on to a trigger rate. The trigger rate is when then your payment is no longer servicing the interest going to be charged to you. In that case, nothing is happening to the client. What's happening is then your amortization get further extended in your mortgage. That's how it is. So if, say, one of the 3 people are in variable, but if that one person out of 10 of the variable holders that is in the so-called adjustable rates, the payment is not changing. So it's not like they're not able to afford it. It's the amortization behind it has been increased. So there is like a slight difference in these type of rates. So if you ask me if you want, should I pick a fixed payment or a variable payment, it's a very personal choice. Some people like the stability. Like some people won't even take a 3-year, even the 3 years on a special. They will only take a 5-year fixed rate, and they're only stuck with 5-year fixed rate. So some people is like, oh, I'm going to ride the market, so I'm going to do the variable rate because I think it's going to come down soon. So it really is a very, very personal choice of the client decide between a fixed or a variable rate. In today's market, there are a couple lenders, they offer multiple mortgage components under the same mortgage, which in some cases you can hold partially variable and partially fixed rate if you want to ride out the risk. So there are a lot, as I said, the reason why I become a mortgage agent is now I have all these solutions for my clients, and it really has to fit in your own financial situation, which term or which type of rate will best fit your needs. As I said, you will see this one is where the blue line is actually the fixed rate and the green and the orange line is the variable rate. So you can see those 2 lines are technically pretty much in sync for like 9 years until January 2021, where they actually dropped the prime rate 3 times in 1 month. That's where you start to see the bigger gap between fixed and variable. So again, it's a personal choice, but we can see is really, really head to head if you want to decide on a fixed or variable rate. So now let's get into the nitty-gritty things. How do I qualify for a mortgage? So there are different types of income is one of the most important things. So we'll say is like, are you salaried? Are you part-time? Are you full-time? Or are you self-employed? So different lenders now have different options for each of these categories of employment, and there is always something that fits. Credit score. Credit score is very, very important in the mortgage world. And when most banks are looking somewhere, if you have your own like credit check, most banks are looking for somewhere around 650 to 680. That is the entry point for most of the banks. Down payment. The down payment actually can come from either gifted or your own savings. And you can even take it out from your RSPs. And there is going to be a new home buyers TFSA coming out shortly. And for gifted, we also have seen in Toronto itself, in specifically in GTA, we have seen parents as a gift average out to be $130,000 to give it to their kids to buy their first home. Mortgage Chau, I actually have touched on it like before, which is the insured, insurable, and a conventional one. So what the banks offer is the banks offer one rate for all of these. Most of this is like, say, it doesn't matter if you have 5% or 20% or 35% down payment, they normally have like very similar rates, whereas other mortgage financing companies out there, due to risk on how much down payment you put down, sometimes like the rates are different when you are able to afford a higher down payment, or if you have less than 20%, because when it's insured, someone else is taking the risk away from them. So they are okay to give you a slightly lower rate in that case. So in short, or in summary, there is a program for everyone. It's just a matter of you have to reach out to discuss what are your plans, so we can actually go and discuss what program is out there among my 40 plus lenders that will fit you. One of the things that can help one of the things that can actually help you to further qualify is extending an amortization. So currently, if you're an insured mortgage, meaning you have less than 20% down payment, you're only allowed maximum of 25 years amortization. But when you have over 20% or more, then you can go up to 30%. 30-year amortization. And there are some so-called B lenders, which are the smaller lenders. Some of them can actually go up to 35. So here, I just want to give you a kind of a look to see is what is the difference when there is a 5-year difference in amortization. And I have enclosed like the actual payment difference for you here. And what is the income required? So if generally, like say if like you have like less than 20% and you have to go for 25 years, if your mortgage amount is $600,000 with a rate of 5.09, your monthly payment is about $3,500, and you need about 179,000 total household income to be qualified. But if we can actually, if you have the 20% and we can extend it to 30 years, then your income is you can be qualified with 170,000. And also your mortgage payment will then actually come down to 30 to 35 or approximately. So you have some savings in your monthly payment based on that. So this is just an example how we can help you to qualify is by using extended amortization. There's also one other product that we can offer, which the bank does not offer. It's called a non-stress test product. What is this is like, these are products for clients that have 20% down payment, but because of the high qualifying rate, they are not able to get qualified. So this is, again, this is a chart that is based on everything that is like on the same playing field with a household income of $135,000. If we're going to qualify you through the qualifying rate, which is the stress test rate, whichever your contract rate plus 2. So I use 739 right now. Your loan going to be qualified is going to be shy of $600,000. However, if we are able to take you to one of these lenders that they don't have to do the stress test, same $135,000 with a contract rate of 6.89, you can actually be qualified for over 650,000. And if I even do like another difference, another 0.5% difference at 6.39, you still be able to qualify over 620,000. So that stress test rate of plus 2% does make a difference of what you can be qualified for. So those are just a couple of the examples of how I can actually help you with all of my lenders that actually to get you to qualify for the mortgage. So in some cases, like I actually have realtors that will come to me is like, Simon does this with me too in our partnership, is like you'll have a client not sure if they're ready to buy, then I'll actually run the numbers behind the scene with a couple of meetings, a couple of appointments with the clients, and I'll run the numbers to say if they're ready to buy, and then I'll let Simon, as I will let the client know, like tell Simon that this is how much you can shop for. Like this is the range of the property that you can buy. And then they will go back to Simon to say, okay, well, Peggy said I can be qualified for this much. So what can you find me? So those are some of the partnership that I have with Simon's